Welcome back, everyone. Next, we have VersaBank. It trades on the NASDAQ under the symbol VBNK and on the TSX under the symbol VBNK, and is a Canadian Schedule I chartered federally licensed bank, which became the world's first digital financial institution when it adopted its highly efficient business-to-business model in 1993, using its proprietary state-of-the-art financial technology to profitably address underserved segments of the Canadian banking market in the pursuit of superior net interest margins while mitigating risk. Happy to welcome founder, president, and CEO David Taylor and investor relations Lawrence Chamberlain, who will be answering some questions at the end of the presentation. Welcome, David. The floor is yours. And whenever you're ready for questions, I'll pop back on.
Well, it's my pleasure, and thank you for inviting me to this. I just love telling the story of VersaBank. Let me move to the next slide, Lawrence. That's the usual disclaimer advisory. Moving along. So as the introduction said, I had the opportunity to create a brand new bank virtually with a whiteboard. And in the past, I'd had a good experience learning about banking with one of the large Canadian banks and a British bank. And I sort of learned what I didn't like about banking. And I guess that would broadly go under the category of taking a lot of risk. So when I designed VersaBank, I did away with best I could with the typical lending risk that's plagued banks over the years. And it worked very well. We've boast a track record of almost no loan losses for 30 years. The hassles that I didn't enjoy in the other banks that came along with collections and dealing with people, eliminated all that by adopting a partner model. Deposit risk that's plagued the industry just recently in the United States, of course, caused a lot of grief for certain banks. I did away with that by creating an expansive network of partners who would send us deposits. Economic exposure, I'll talk about that a little bit further, but I actually created a counter-cyclical deposit source so that when folks are worried about recessions and such in our bank, it actually a good thing for us. Interest rate risk, I didn't think it was appropriate for any bank to take interest rate risk. So interest rate risk we managed to neutralize as best we can. And of course, by adopting a technology model, partner model, we're blessed with tremendous efficiencies that allow us to grow rapidly without having to spend any more money on bricks and mortar and branches in the typical fashion. So to describe VersaBank, I'd really say it's a technology company that managed to get that elusive, coveted federal bank license. I think a lot of technology lenders would love, but I managed to grab one of those. I was the first person in Canada in 18 years to get a brand new federal bank license. And so what you see today is what I actually originally had in mind. It was a branchless digital bank that picks and chooses markets where we think we can make extraordinary profits without taking on a lot of risk and leverage our technology. So looking at this slide, the operating leverage, of course, you're starting to see nicely unfold in this last year or two as our loan portfolio has been growing and the fixed costs have remained relatively flat, giving rise to a tremendous increase in earnings. As I was saying earlier, various techniques we use to mitigate risk, at least of which is requiring cash collateral for a good portion of our portfolio to offset the inevitable losses that a portfolio would normally present to a bank. Track record, it's just a wonderful track record of rapid growth, and I think it was 90% growth year over year on EPS this year that just ended. For those that follow us, you'll know that we have aspirations to bring our point of sale, technology-based point of sale program to the United States. We've applied to purchase a small U.S. federally regulated bank that gives us access to the entire country. And with that, with Canada, of course, that's the entire North American market. So we're keen on the idea of bringing this new technology to the United States as soon as possible. And to keep our bank safe from the onslaught of cyber criminals, we created our own cybersecurity firm to keep us safe. But being the entrepreneurs that we are, we thought, why not keep others safe too? And we have about 400 high-value clients in North America that we provide the cybersecurity for too. On the slide here, I've got free option, because the way our stock's priced, this cybersecurity firm is either valued at zero or something less than zero. So for anybody that buys our stock today at today's prices, gets themselves a cybersecurity firm and a federal bank, all for the price of one. Alrighty, looking at this slide, this is to depict the B2B model that I put in place in '93. I didn't want to, I was saying earlier, to have to create a huge branch network. We, in fact, have no branches, which gives us the benefit of that. There's no place to run to if you're worried about a run on a bank. In our world, there isn't a branch network or even a fancy website to pull your money out. So the partner model on the deposit side, we utilize wealth management firms, which includes some of the large Canadian wealth management firms that are subsidiaries of the Canadian banks. Most of the independents in Canada, it's about 120 or so deposit partners send us deposits each day. And on the lending side, we've got sort of the mirror image of that going on. We have partners that provide point of sale financing. And the point of sale is when you go to buy a motorcycle, a hot tub, a car, maybe you're doing some rentals to your house. Usually the vendor will say, would you like to pay by the month? And if you say yes, it's quite likely that your loan will end up on the books of VersaBank in our, what we call electronic warehouse, unless you didn't pay us back. If it goes 90 days in arrears, then the deal we have with our partners is the loan goes back to them, and they look after the collections, i.e. dialing you up and say, hey, where's the payment? So we really just kept it to a white glove business whereby we operate as software engineers, two beautiful tech facilities, one in the middle of Canada at the University of Saskatchewan and the Innovation Center, and the other one at London Airport, and let all the human interactions take place with our partners, letting us do what we do best, i.e. manage the portfolios and the deposit gathering, keep improving the software to provide our partners with the very best in technology as a partner. Moving along. Well, this slide is to depict what I was talking about a bit earlier about my allergy to risk. And, I thought you can't have your cake and eat it too in the banking industry. There's no real requirement for a small, nimble bank to take on a lot of risk. And this slide shows that. With respect to credit risk, that sort of plagues banks in the times of recession. As you can see, our little bank has had nothing more than a few basis points negative and positive with respect to provisions for loan losses, because we haven't had any loan losses. We still have provisions as required by our regulators, but very little in impact to our income statement, in that we don't have the normal credit risk that every other bank I know of would have. Deposits, again, very sticky deposits. We purposely go after only term deposits in the wealth management area, And then the other deposit business that we have is catering to the insolvency professionals, also very sticky, because I certainly didn't want to be vulnerable to runs on banks. I was saying earlier that you get, even if you're a digital bank and you offer high rate daily interest savings accounts whereby someone can pull their money out in a heartbeat, move it somewhere else, and in an afternoon you can find yourself insolvent. So we don't offer those. Why would we? We get all the money we want in the term deposit receipt area, and it's worked just fine for us. So moving along, Lawrence. So this is a lovely graph. This is sort of illustrating what I've been talking about as the loan portfolio has been growing, and the cost to run the bank has remained relatively flat, 49 million, 50 million this year, with the loan portfolio growing and the net interest margins being the widest in Canada. I think a very probably the sort of the top of the heap in United States too, but perhaps not the highest in the United States, but they're certainly the highest in Canada. So we got the widest margin. We don't give anything back for loan losses. And that just means that the net interest income drops to the bottom line of the bank and produces some remarkable profitability figures. I was alluding to earlier, about 90% year-over-year growth in EPS. So it's a wonderful model. And it's just getting better each day. Each day we book more loans, and hopefully get a whole lot better when we're finally blessed with the ability to operate our bank in the United States. This little slide talks about what I was alluding to earlier. 94%, I guess, 94% increase in EPS year over year. Sequentially, quarter by quarter, 25%. Those are the kind of big numbers you'd expect a technology firm to be able to produce. It's what it should produce. We can process tremendous volumes of loans and deposits without very much in terms of increases to our overheads. Unlike the traditional banks, that have to build more branches or hire more people or all that troublesome stuff that I try to get away with. So efficiency ratio is what analysts like to look at with banks. 45% right now at the year end. That's pretty good. I think maybe the best in Canada. One of the best probably in the United States, but it's due to get a whole lot better. That's in effect the cost in cents to earn $1 of revenue. So 45 cents to earn $1 of revenue. But of course, if your revenue keeps growing and your fixed costs remain the same, the cost to earn $1 of revenue keeps getting better. On an ROE basis, we ended the year with 13.58. Not bad, but it's been growing at a rather fast trajectory. What does it say there? 626 basis points year over year. And it's on that slope. So at the end of the year, I think we're running around this. Our year end in Canada is October 31st. We're running around 15%, and each quarter it just keeps getting better and better as the loan portfolio continues to grow. All righty. What is that? The ROE, of course, will be getting better and better with as I was talking with the loan growth. Minimizing our cost of funds is always something we keep our eye on. Mind you, with the network we've set up and the network we're working on in the United States, I think you'll find that our cost of funds will even drop lower than it has been. And that vis-a-vis Canada, the U.S. deposit market seems to be over the risk-free rate seems to be quite a bit less than Canada. We run around 50 basis points over the risk-free rate. United States, it looks like 10, 15 basis points or even less seems to be the norm. So you probably see our cost of funds overall with the U.S. With the U.S. bank license go even lower. It is possible that we'd see some accretive acquisitions going forward. Mind you, our dance card is sort of full right now with the finalizing the purchase of that U.S. bank I was talking about. Moving along. All righty. Well, this is slide to illustrate the tremendous market that's just south of the border. And we've been growing 30% in Canada with our point of sale business, but the U.S. market, maybe the largest point of sale market in the entire world, could be 100 times bigger than Canada. And our proof of concept program for the last 2 years sort of proved the concept that there really isn't any competition, direct competition with our kind of new product that we're building in the United States. So, we're really excited about what we can do for the U.S. point of sale market, how we can help out with our economical, timely funding product that we're hoping to bring soon. All righty. So this is a key component of our growth strategy, the obtaining this OCC chartered bank in the United States to give us access. For those that be wondering about, is that a tremendous amount of work, Dave? You're going to spend a lot of money going into the United States, constructing branches and such? No, of course not. We're a cloud-based bank, and figuratively and literally, we actually operate right from an airplane in the cloud. This is virtually seamless between us and the United States. When I look down from the airplane, I don't see a border. Our cloud-based bank data is stored actually in the United States. It's backed up in a server in Canada also. So it's virtually seamless for us to erase the border and start providing the services in the United States. Looking at this next slide, that orange one is the wonderful one. That's the ROE heading up like a rocket, and that's just those factors that I was talking about earlier. Fixed costs remaining fixed, net interest margin remaining somewhat fixed, and growth in the loan portfolio providing increased revenue that's dropping straight to the bottom line. The milestone I had in this slide a while back was $4 billion. We got punched through that in 2023. Next milestone will be $5 billion. The numbers that should produce is an efficiency ratio less than 40% I was talking about earlier, and ROEs in the 16.5 or better. That's just the trajectory that we're on right now. $6 billion, it just gets better. And if you want to dream in Technicolor, numbers like 10, 20 billion, it's really, really nice. Alrighty, this is the free option. And as I was saying earlier, if you're going to create a digital bank in today's day and age, there's a lot of folks who try to steal your data or your money, cyber criminals. Back in the early days, and on a side note, when I was going to university, I decided to be a maximum security prison guard, and I got a chance to deal with old school criminals that had robbed banks in the old school way with a shotgun and such. So later on, when I designed a bank, I thought to myself, we're not going to be vulnerable to the criminal element, and I created DRT Cyber. I was blessed with the head of BlackBerry's Cybersecurity, Gurpreet Sahota, joining with us to put this all together for us. BlackBerry, as you know, had a legendary in that area. I don't think anybody ever hacked a BlackBerry. So then, we're entrepreneurs in this bank. You probably gathered that, and we thought, well, it works for us. Maybe it could be helpful to other high-value targets in North America. And so we have about 400 or so of the who's who in North America. That'd be police departments, government entities, transportation lines, big retailers, other banks that utilize us to protect them from the onslaught of those criminals that may be operating out of someone's basement in some other country somewhere. Who knows? But nevertheless, DRT Cyber's job is to keep them outside.
David, Lawrence here. In the interest of time, why don't I put up the investment summary on the screen, and we'll move to Q&A.
Absolutely.
All righty. You guys ready for some questions?
Sure, absolutely.
Okay, great. We do have some questions. Some of them are a little long. I'll try to condense as much as possible. Well, excluding any one-time expense related to the purchase of Stearns Bank, do you think non-interest expenses can stay flat at roughly $12.5 million a quarter plus inflationary increases in fiscal 24-25? And what's the asset level threshold where you believe it would necessitate an increase in non-interest expense?
Well, first part of the question, yes. That's what I believe is that our fixed costs can remain as they are. However, of course, we've seen a fair amount of inflation, so particularly in salaries. So look for the salary component to reflect inflation going forward, but not much. It's 4 or 5%, something like that. There isn't any sort of quantum increases in fixed costs in our model. It would just be over as time progresses and the volumes increase, we might hire more IT people, more processing people to keep up with the volume. So there's no big quantum jump in expenses. So you'll see year over year slight increases due to volume. But nothing in a material size.
And how is the point of sale receivable purchase program ramping in the U.S. via the finance company vehicle? And do you have a large enough sample size to estimate the yield in the U.S. versus Canada?
Yeah, we've got about 100 million, and the net interest margin we're earning is approximately 4%, vis-a-vis Canada's 270. So it's a better margin. And that's what I was alluding to earlier on the slides. The cost of funds in the States vis-a-vis the risk-free rate tends to be lower than Canada. I guess, thankfully. Thank you very much, United States. I don't know. We could speculate on the economics of why that's the case, but it is a better market. We have used it just as a proof of concept, 100 million as a sample set. We want to have live customers. We have 3 live customers now to run through the legal works, the jurisdictions, and all those sort of things, NITs, when you enter a new market. So that took place about 2 years ago. So we're all set to go now, geared up, ready to roll. We think we have a tremendous amount of enthusiasm for our product in the States, particularly in the last while, because the exuberant markets have dried up. That used to be a good funding source for point of sale companies. So our sort of steady, economical technologies product is in super high demand.
And the most recent investor presentation points out a pursuit of accretive acquisitions. So considering the non-traditional model of VersaBank, what could a future accretive acquisition look like?
Well, as I was saying earlier, I haven't really got anything on the radar screen right now. We're focused on the Stearns Bank acquisition, and the point of sale program has the potential to ramp up so rapidly. Everything else pales in with respect to those opportunities. However, I shouldn't rule out, say there was a bank in the States that happened to have a similar business to our point of sale business, something that could be adapted over to our point of sale business. That could look attractive. We love our model. It's almost risk-free, and it has tremendous growth in it without a lot of fixed costs. So you'd be really a little careful about the traditional community banks that tend to have a lot of overheads. And but if there was something that we could adapt rapidly without too much cost to our model, we could take a look at it.
Well, speaking of your model, a viewer says, as you approach the near-term milestones of 5-6B assets, 40 to 35% efficiency ratio, 16.5% to 20% ROCE, do you think that VersaBank's unique model could sustain and maybe even grow past these metrics? Oh,
absolutely. Yeah, we just threw those metrics up. They're just math. It's just derived from the model itself. It just gets better and better as the volume builds. I mean, our software is capable of handling it maybe 10 times, 20 times, 30 times volumes that we presently have. And with a little bit of tweaking, we can 100 billion. It's It's, it's your classic cloud-based software that I had hand building back in '93, and we just kept evolving it, and new versions. So it's sort of the banker's dream. You can grow without adding more risk. That's one thing that banks often fall prey to, i.e., growing rapidly and forsaking risk and then having it bite them later. The point of sale program isn't that way, because the cash collateral that we hold back in order to offset the loan losses in the portfolio, and the software is highly leverageable. It's what a tech company wants to do, but very few of them manage to get a bank license. So that, as I say, it wasn't easy. It took 18 years.
Well, congratulations. Finally, Frederick Lindstrom asks, he mentions in the autumn you announced you expected your regulatory response from your acquisition in the US late autumn. So what's the delay? And when was the last time you had contact with the decision makers?
Well, the delay was the holiday season. We got, I think it was around December 15th, and it looked like everybody was planning to go on holidays, including some of our staff. So long story short, the holiday season delayed it. I'm not sure when the last contact was with the U.S. regulators. There's a number of regulators, those that are in the know. But no, we have the OSC, the Federal Reserve Bank, and FDIC. I'm not aware of any issue. If that helps the questioner out, I'm not aware of any outstanding issues at all. The OCC in particular spent a lot of time with us, getting to know our model, and having the proof of concept working in the States was really helpful, because they could actually look at real live deals, real live legal documents, real live customers, which I think was super helpful in getting them comfortable. It's basically the same strategy I used in Canada. I bought a little tiny finance company called a trust company in Saskatoon. I demonstrated the regulators a branchless digital model with this little tiny trust company, so they could see what I meant by how it would work. And I think that's why I was able to do that had been impossible for others to be granted a federal bank license, because I didn't just produce a business plan. I produced a real live model that people could go and see, witness. Okay, so that's how that works. It is, when you're sort of groundbreaking in a technology area, it's great because it creates all kinds of opportunities. But when you're doing something brand new, regulators quite rightly spend a bit more extra time proving it out.
Thank you for that. Frederick also asks, is there an intended plan B just in case the previously announced acquisition in the US does not go through?
I always have plan Bs. Let me just stop that. Yes, I'm a multi-engine IFR-rated pilot, and I like two engines, so I always have a plan B. Yeah, we have a plan B to roll out in the United States. It won't be quite as profitable as up to having a bank license and funding with deposits, but there's other alternate source of funding that we're exploring right now to be able to roll it out so we don't lose any time.
And Jonathan Art asks for you to explain in greater detail the difference between your POS funding product and those of the many U.S. incumbent BNPL players.
Yeah, well, what the buy now pay later players would theoretically be our partners. So they'd be looking for us to purchase their loans and leases as they generate them. And we're able to do that electronically, and if they want, on a daily basis. And as time progresses, we may very well roll out a sort of a real-time purchase of their loans and leases as they generate them. So then they reside on our balance sheet unless they go into arrears. If they go 90 days in arrears, automatically that loan or lease goes back to whoever sold it to us, and they look after the nasty part of the business, i.e. the collection, dialing up Mrs. Jones, asking her why she's not made the payment. So we're bankers. So we trust our partners to take them back as they go into arrears, but we also hold back a fair amount of cash. So each one of the partners has on deposit with us a substantial amount of cash so that we can debit their account to affect this transfer of ownership back to them. So that's the secret sauce. That's why we can talk about not having losses, is that that cash provides sort of a first line of defense against a loss for our bank. I mean, it would be theoretically possible for us to exhaust the cash. It's never happened in our history. And we are always topping it up and doing stats on it to make sure that we've got usually about 3 times the cash of the worst loss year of a partner. In COVID times, I think we had about 8-9 times what expected loss provision calculations would show. So we hold a lot of cash back, and that's how it works. If you actually thought that VersaBank was here to take a little risk, you best go somewhere else. There are folks that have knocked on our door and had sort of a risk sharing model in mind. That's not for us. We just provide this electronic warehouse, and it's wonderful. But you got to look after collecting your own loans.
Fascinating business. Thank you so much for joining us. We have a lot more questions for you, but we're out of time. That means you just got to come back on our conference again and give us some updates. Thank you, both gentlemen, for being with us today.
Well, I'd love to. Thank you. It's been a lot of fun.
You're welcome, Anna. And we'd ask anybody who has additional questions or they didn't get their questions answered to please go to the website, find our contact information, and please feel free to email those over, and we'll be happy to get back to you as soon as possible.
Perfect. Thank you, gentlemen.
Again, thank you all. See you.
Okay. Stay with us, everyone. We'll be right back.